The second and third largest bank failures in US history happened last week. Here's what you need to know. So let's start with Silicon Valley Bank. This bank is the go-to bank for a lot of the venture capital firms and also tech startups in the Silicon Valley area. In 2020, 2021, we had a huge influx on people starting tech firms. So we had a mass influx, or Silicon Valley had a mass influx of actual funds going into the firm itself. When you look at how banks make money, they reinvest the funds that you invest with them. So your funds aren't necessarily just sitting there at the bank. They're reinvesting those funds and making money off of your money. What Silicon Valley was doing was they were investing in more conservative investments, which are mortgage-backed securities, treasuries. They're more conservative with less market risk, but they still have interest rate risk. And this is so important because in 2022, we had interest rates from the Fed that just kept climbing. As those rates were climbing, as we had more interest rate hikes, the actual prices of those components with mortgage-backed securities and treasuries were going down in value. They were in a real pickle when they're holding a lot of these investments inside of those assets themselves. This forced Silicon Valley Bank to actually sell investments at a loss. They had to actually go public and say, we need to raise capital for our investors and the institution itself. By doing so, they spooked a lot of the investors who deposited money in SVB themselves. And we know last Thursday, investors initiated a withdrawal of $42 billion. About 96% of the actual total deposits with SVB were not insured by the FDIC insurance policy. SVB had to freeze actions on all accounts, online transfers, wires, all of it. This led to the FDIC having to step in and take control of the bank itself. Stay tuned for part 2, where we'll go over what the FDIC is and how they play a role in the banking system.